I'm Professor Indra Abeysekera. We're going to look at eliminating intergroup transaction related to inventory occurred during the current period, but end of the current period it is partially held. Let's look at an example to illustrate the consolidation journal entries. On 1st of July 2018, parent acquired 80% of ownership in subsidiary. The proportion of ownership of the parent in the subsidiary has no relevance to the intra-group transaction eliminations. When it comes to inventory, non-current assets, intra-group transaction, they are eliminated in full regardless of the proportion of ownership of the parent in the subsidiary. On 1st of January 2020, during the current financial year, subsidiaries sold inventory for 24 million with a profit margin. At 30th of June 2020, that is the end of the current financial year, in this example, 40% of inventory is still on hand with the parent entity. Income tax rate of both entities is given as 30%. We are going to look at the consolidation journal entries that are required for the end of the current financial year to prepare consolidated financial statements. If you look at this in a graphical form, subsidiaries sold inventory costing 21 million at 24 million and made a gain of 3 million. That 24 million was bought by the parent entity and recorded as purchases under cost of sales. And at the end of the financial year, it was transferred to the balance sheet as inventory. Here, for this illustration, we are assuming that the parent entity is following the periodic inventory system. The inventory that's recorded on the balance sheet at end of the financial period is 24, comprising 21 of that original cost of inventory, which includes 3 million of unrealized gain, the unrealized gain made by the subsidiary. This is if 100% of inventory is still on hand with the parent entity. But what we know is that 60% of this inventory has been sold outside the group, which means that the group has earned 60% of that unrealized profit and 60% of the overvalued inventory, because unrealized profit is included in the inventory. 60% of the overvalued inventory also been sold. So the unrealized gain is now restricted to 40% and the overvaluation is now restricted to 40%. At the end of the financial year, all we see is the unrealized gain of the subsidiary that is included in its profit and the inventory of the parent entity on the balance sheet, which also includes the unrealized profit. We can also understand about the consolidation journal entries by looking at the general journal entries. The subsidiary, when the inventory was about to be sold, it prepared the inventory for the sale. So it credited inventory 21 and debited cost of goods sold to prepare for the sale. It was then sold for 24 million, credit, sales 24 million, debit, cash 24 million. Parent bought it and recorded as cost of goods sold 24 million debit and paid cash 24 million. End of the current financial year, it transferred from cost of goods sold the unsold inventory into the balance sheet as inventory 24 million. At the moment, we are now assuming that the inventory that has been sold from subsidiary to the parent is 100% held by the parent. So there are two things that occurred here. One is subsidiary sold inventory to the parent. So we credit sales and debit cost of goods sold, because there's a sale transaction and a cost of goods sold transaction. If we look at the first two lines of the journal entries of parent and subsidiary, cash cancels out. What's remaining is credit sales and debit cost of goods sold. That is now summarized by combining the two sets of general journal entries. Summarize that as buy and sell transaction, debit cost of goods sold, and credit sales 24 million each. If you look at on the general journal entries of individual entities, of the last two lines, last two rows, we have inventory, which is the net is 3 million, a debit. That is the overvaluation of inventory. Inventory has been overvalued by 3. Debit inventory 3. Cost of goods sold is the net effect is credit of 3. The credit cost of goods sold 3. That is for the unrealized scale of inventory that's been sold. So the unrealized scale of inventory is now in cost of goods sold. There is no dedicated account to show the gain on sale of inventory because inventory is a trading asset. Let's now look at the consolidation journal entries. We can use the graphics or the summarized general journal entry transaction as a basis to prepare consolidation journal entries. The first one is buy and sell transaction. We debit sales and credit cost of goods sold for 24 million. That is for the trading transaction. The second is the unrealized profit and overvaluation of inventory. That is now restricted to 40%. For 100% of inventory unsold, the overvaluation and unrealized profit is 3 million. That is 24 million less 21 million. Now that's restricted to 40%. So we multiply 3 million by 40%. We debit cost of goods sold 1.2 million and credit inventory 1.2 million. Because we are decreasing cost of goods sold, there's a taxation impact. Because we are decreasing inventory value, there's a taxation impact. So our third entry is to account for the deferred taxes and the income taxes from the adjusting for the unrealized profit and overvaluation of inventory. Because we are increasing expenses, the profit decrease in the group. The income tax expenses decrease. 30% of 1.2 is 0.36. We credit income tax expenses. We are decreasing the inventory value, which means we are expecting less future cash inflows. If there is less future cash inflows, there will be less future taxes. So this tax saving, we debit deferred tax asset 1.2 into 30%, 0.36. In inventory, intra-group transaction, there are three sets of transactions. The first one is buy and sell transaction. We debit sales and credit cost of goods sold. The second is the unrealized profit and overvalued inventory transaction. Eliminating them, we debit cost of goods sold and credit inventory. Third is the deferred taxes and income tax adjustment that's resulting from the second consolidation entry. We debit deferred tax asset and credit income tax expense.